recent data in the UK has shifted sentiment in markets. So let's take a look at that. Hello and welcome back to our channel. My name is Daniela. In today's video, we are going to be focusing on the UK. We're going to be looking at UK assets on the charts and reviewing some of the data that's come out this week. But before we get into it, please like this video, comment, subscribe. And as always, if you have any questions or suggestions, feel free to leave them in the comment section below and we'll try to get back to you as quickly as possible. So as I was saying, we've seen some data out this week that has shifted sentiment in markets a little bit, specifically if we're looking at UK equities. So let's quickly recap, because it's just over a month ago we got confirmation that the UK economy had entered into a technical recession in the second half of 2023. Now that happens when you have 2 consecutive quarters of negative growth, which happened in Q3 and Q4. And of course that spooked investors a little bit. It kind of saw a little bit of risk off in UK assets. But data this week has actually brought a little bit more positivity into UK traders. And that is because on Tuesday, we saw the latest job data and it started to show a cooling in the tightness in the UK labour market. So we saw wage growth dropping, rising less than expected and rising less than the previous month in January. So average earnings, if we're excluding bonuses, rose 6.1% in the 3 months to January. That is a drop from the 6.2% in December. Similar, if we include bonuses, we actually saw a bigger drop than expected, rising 5.6% in the 3 months to January versus 5.8% in the previous month and 5.7% expected. So that essentially gave a view, as I said, of a cooling labour market. And one of the key concerns of central banks across the world, specific to the UK as well, to the Bank of England, is the fact that wage growth has been strong. It's been putting pressure on domestic inflation. And as we know, the UK economy entered a technical recession in 2023, but also has one of the most stubborn inflation of the developed economies, more so than the US, than the Eurozone, than Canada. So there has been a lot of concern as to how the Bank of England was going to manage bringing down inflation to that long-term target, but also making sure that growth doesn't hinder in the process. The data that we got for the end of 2023 wasn't giving a positive sentiment at all. As I said, contraction in the last 2 quarters, inflation still above target and coming in higher than expected in the last few months of the year. So that, of course, put some further pressure on the Bank of England. But the jobs data on Tuesday really helped ease some of those concerns. We saw that the 3-month employment change had actually dropped. The unemployment rate rose to 3.9% from 3.8%, again, showing a little bit of an unwinding in that tightness. Vacancies also dropped. So that started off a kind of wave of positive sentiment because it validated the fact that, the economy is moving in the right direction in terms of some of those price pressures, and it allows the Bank of England a little bit more wiggle room to act. Nonetheless, it still remains high. Wage growth still remains way above the long-term average. Inflation still remains high. We'll have another inflation reading next week before the Bank of England meeting on Thursday. But there is potentially a little bit more security in the fact that the Bank of England could manage the situation. This morning on Wednesday, we've seen further data. We've seen the growth data, and it's actually showed that the UK economy grew 0.2% on a monthly basis in January. Again, that is a positive reading. It's not out of the woods yet. It's not in the clear, because if we're looking at the 3 months change, it still came in at minus 0.1%. So on a quarterly basis to the month of January, it's still contracting. It's still seeing negative growth, but nonetheless, that positive reading and sentiment does give hope that the UK could exit the technical recession in the first quarter of 2024 if it continues this way. We also saw construction output coming in higher than expected. Industrial production did drop, but in general, the sentiment around the growth data is positive, and we've seen a little bit of follow through in the market on the back of that as well. So generally, the data has seen a little bit of an unwinding of that tightness in the labour market. whilst we've seen a return to growth in the month of January, and that has culminated in some bullish appetite for UK assets, specifically the FTSE 100, which we'll look at the chart in just a second. But I also want to recap on the fact that we had the budget last week unveiled, and that was essentially a non-eventer for markets, which is a good thing. We did see Hunt unveil some cuts to national insurance, but his hands were pretty tied. There wasn't much he could do because of those warnings from the IMF that the UK economy has unprecedented levels of deficit that needs to be controlled. So it wasn't giving the government much wiggle room, even if there is an election further down the line this year that they want to kind of attract voters for. The fact that Hunt stayed on track, stayed on script, didn't over-deliver on things that he can't, or didn't over-promise on things that he can't deliver, did keep markets calm. It wasn't necessarily a massive event for the UK economy, but at least he didn't interfere with the Bank of England's mandate, which I think is where a lot of the focus is in markets right now. So in terms of the Bank of England meeting next week, no expectations of any rate cuts. Of course, we've still got clear signs that inflation has not fully eased. The labour market, even though it has started to cool, is still pretty tight, and there is still wage growth that could affect domestic inflation further. So there is no real desire to cut rates at this meeting. Markets are currently pricing in 71 basis points of easing in total this year. That is up from 60 last week, and that is, of course, after the data this week. So that shows that the softer wage growth, but also the return to GDP growth has given markets a little bit more hope that we'll see more rate cuts this year by increasing those basis points priced in for 2024. There's a 47% chance that we could see a 25 basis point cut in June. Of that, there's only 15 basis points fully priced in. So again, unlikely that we see it in June. It's most likely that we're going to see a rate cut in the month of August, where there are currently 28 basis points of cuts priced in. Let's jump onto the chart now to see how UK assets have been performing. So let's kick it off with the FTSE, Capital.com via TradingView as always. And as you can see here, this return to positivity coming this week, seeing that push higher in the FTSE after a few weeks of stagnation. And one thing to say is that the FTSE this week is outperforming its European and American peers. So the positive momentum is slightly isolated to UK assets. So it can be related to the fact that sentiment in the UK assets on the UK market has improved. Now, one thing to note for the FTSE 100 is that there is a key area of resistance up ahead that's been in play pretty much since May last year. Now, as you can see here, we hadn't actually achieved a positive close above 77.45 since May last year. So even though we'd had a few attempts of breaking above that area, and we did see some breaks, we saw, for example, here in December last year, we saw the FTSE pushing to 77.68. We didn't actually get a close there. It came down on the day, showing some weakness in the bullish advance. On Tuesday, so yesterday, was actually the first day that we saw a close above 77.45 in almost a year. So that in itself is a positive sign for the FTSE. It shows appetite from buyers to continue pushing higher. We do still have a little bit of resistance here in the RSI, as you can see. In fact, we're actually seeing a lower high in the RSI. You can see here the 19th of February was higher than where we are now in March. It's not exactly the same in price. You can see back here, the 19th of 20th February, price was actually below the highs from yesterday. So a little bit of an RSI divergence here, potentially suggesting a little bit of weakness in the rally. And of course, buyers still need to push above the upper bound of this resistance at 77.68, 77.69. So not fully out of the clear yet in terms of the bullish momentum, but there is a clear indication of that positive sentiment coming in to the UK FTSE 100. Of course, with the Bank of England meeting next week, that is going to be a key driver and catalyst of momentum. We'll also have the latest CPI data next week as well prior to the meeting. That could ruffle some feathers as well, see some increased volatility. But there's definitely appetite to push higher. and the RSI still has room to go if we're able to break that resistance up ahead. Let's take a look at cable now. Take a look at the pound. As you can see here, we've seen a little bit of weakness in recent days in the pound, even after the positive data has come out. That's mostly on the back of the dollar dominance. FX markets have been dominated by the dollar in recent months. In fact, if we look at the dollar index chart and we look at cable, we're exactly seeing the opposite. So that resurgence that we've seen in the dollar in the last few days has weighed on cable. But we were slightly overextended as well. You can see the RSI here pushing above that 70 line after that strong rally that we saw last week. So nothing to be too concerned about. But of course, there is some weakness in the move higher for the pound. It looks like we could be recovering some of that momentum. But if also the pound continues, or FX market continues to see rate differentials as some of the key drivers. And of course, if the Bank of England is seen to hold rates for longer than the Federal Reserve, that does favor the pound over the dollar. The fact that the data has come in softer in the recent days has increased some of the odds of rate cuts from the BOE. So also weakening the pound in terms of rate differentials. But nonetheless, a lot of the market right now dominated by the US dollar. We could see a little bit of reversal higher. We've got some key events on the calendar this week, like the Federal Reserve, like the Bank of England, like UK CPI. So all of that could factor in. But for now, it looks like UK assets are getting a little bit more of positive sentiment after the latest data. That is it for today's video. Thank you so much for watching, and don't forget to subscribe to our channel.